did have a couple of questions come in. If you joined us late and want to ask a question, there's a Q&A panel, should be a Q&A panel on the right side of your screen. Feel free to type a question in. So Kyle and Will, one question that came in, if an owner has a sizable company that meets your criteria, but they also have, let's say, $1 million or several $1 million in debt, how does that work in terms of recapitalization with the private equity firm? Does the owner remain liable for all of that debt, or does KLH assume a percentage of that existing debt, or do they put new debt in place? How does that work?
Yeah, that's a great question. I think the simplest way to characterize it is that in 98% of KLH's deals, there is some sort of third-party financing that is utilized to achieve the total valuation. I think that, the use of debt as a source of capital in private equity transaction is something that is, common across all private equity transactions, and is part of allowing, the private equity firm and, frankly, the management team to accelerate their returns on the investment. Key to our transactions, which may or may not be consistent with all other private equity firms, is that under no circumstances do any individuals in a KLH transaction guarantee any amount of debt, whether that's debt to KLH, the shareholders. Our investment is not guaranteed, but also to third parties. The line of credit would have no guarantees, any term debt utilized would have no guarantees, and any mezzanine debt would have no guarantees. And frankly, that's a fundamental shift for many of the businesses that are within the size range that we invest in, because oftentimes if we're doing a recapitalization, entrepreneurs have been personally guaranteeing their $3 million line of credit. And it's kind of a terrible world, but the reality is when someone like KLH becomes involved with the business, the banks change their opinion of whether or not they need that personally guarantee. And for better or for worse, that's how the market works, and our involvement triggers the banks to behave differently, and opens up new financing sources to the company. So I hope that answers the question.
Good. Boaz, I'm going to unmute your microphone here. We had a question that came into us. I'm not clear on what Navocate's role is in working with private equity. Can you explain that briefly?
Sure. Instead of going to shop with many private equities and learning which one of them is a good fit for you, Navocate can help you first assess whether private equity is a good fit for you, and second, which one of the private equities will be a good fit for you. I would venture to say that KLH is probably a better choice for most of our clients compared to the bigger $2 billion and above under management type of private equities that are the more prevalent and known names. At the same time, there are cases, for example, a medical device company that, while KLH is a fantastic profile of a partner, there are private equities that focus only on medical space and healthcare and may be a better fit. So there's a lot of considerations that require long-term familiarizing oneself with what aspect and what specific venture and private equity may be of best fit for a specific situation. That would substantially shorten the time, and when you come to, for example, KLH with a good candidate, it not only shortens the time, the fact that the fit is there from both ends up front speeds up and ease up the entire experience, both in terms of times and the difficulties that may come.
Okay, great. Thank you. Now, we have another question actually from Barry Etra, who is in Atlanta. Barry and I know each other. And Barry, I'm just unmuting your speakerphone, your telephone here, so we don't have a lot of people. You can go ahead and ask KLH your question directly.
Okay, well, then I have to take it off speakerphone.
I
have a client I've been working with who is grown relatively rapidly, but really expects to grow, I don't know, about 5 times in 4 years. And they are looking for funding because they need to do a small acquisition and they need to really get their name out because they have a truly superior product in their space. But they're not going to give up, my guess is they would not give up 75% of the company. They're looking to give up somewhere in the 25 to 40% range. Is that something that you'd be interested in?
Yeah, I mean, without knowing anything else, of course, we would like to learn more. There's no replacement for momentum in earnings and momentum in growth in the investing world. So anytime you see something that is hot, it has to draw attention. In terms of kind of the scope of the transaction, if that situation, depending on the size of the investment needed to do the acquisition, and depending on where the company is in its own cash flow growth, it could be a candidate for mezzanine financing, which would allow frankly the management team to maintain maximum ownership while raising the capital to execute the add-on. But the company would need to be, for lack of a better term, sophisticated enough and have the financial controls and the cash flow capable of supporting debt, and debt from a sophisticated investor in order to raise that. So without knowing any more, I think if the company was fairly mature, had $2-3 million of cash flow, and was able to articulate their growth plan and all that, then hey, that they may be in a great position to maximize their ownership and just raise third-party debt. If they don't have that much cash flow yet, and maybe don't have all the systems and controls in there that the lenders would look for, then it might be a much better fit for someone like KLH, who can assist them in putting those things in place through our involvement, and can also obviously execute the add-on acquisition. It's not something we touched on in our presentation, but KLH has a knack for focusing on growing via acquisition. In our current portfolio, we've done more add-on acquisitions than platforms. So, we've executed for one business we invested in last year. We've already executed 2 add-ons, and we're doing one more within, I guess this is the 13th month we've been invested. So we're on our 3rd add-on in that business already. So that's an area of expertise that we have, that we can help be we can provide good counsel to a management team as they look at an add-on and help determine if it's the right one for them and how to price it, how to execute it, how to integrate it, all that type of stuff. So the short answer is yes. I mean, it's certainly something we would consider, and if it's not for us, we can provide you with various other references that that you may want to approach.
Okay. Yeah. I mean, they have the financial controls. Everything's there. I think they've grown so fast, I'm surprised. I thought they'd have better cash flow than they do right now. They still have half-decent cash flow, but it's not 1.5 yet, or $2 million. It's about a $10 million company.
Yeah. Well, and that's why, I mean, there exists, as we can all kind of see in the marketplace and from experience, there exists a kind of a typical path that companies go through of, an idea, start to grow, you raise a little bit of outside money, you give up a little bit of ownership, you raise some more money, you give up a little more ownership, and then you reach that peak where you start cash flowing, and you reach a more stable, and mature point in the business's life cycle where then you have access to, debt because of the stable cash flow that's existed for several years. And if they're not quite there, an equity investment is typically the right path for someone that has an opportunity they want to take advantage of, but they're not at that point where cash flowing, several $1 million worth of debt on an annual basis is a worthwhile, strategy.
Okay.
Barry,
So
that... Go ahead.
Go ahead. I was just going to say we're happy to help in any way we can and look at the opportunity and provide whatever guidance we can.
Okay. Thanks.
Okay. Thanks, Barry. We have another question from Paul Winkle. Paul, your telephone's live. Go ahead.
Oh, how you doing, guys? I work for Carl, and I have a question. When I'm talking to prospective clients, and I do mention that we can help connect and partner them with private equity, I tell them that they're professionally managed funds for expansion and growth. The question I have is, at some point in time, there will be an exit, and I let them know that right up front, anywhere from 3 to 7 years out. So what is your method for exiting, and what type of returns that you typically look for based upon your value drivers?
Sure. I think that as you look at, and I'll kind of break that into two questions. The first is, the discussion of when to exit and how to exit. And, I think that we are a little unique in the way that KLH approaches those things, because we let our management team drive a lot of that decision. Inevitably, it's been our experience that, you don't have to push management teams to sell at the right time. The management teams are hopefully more in touch with their market and the market dynamics, what's going on, the prospects for growth, et cetera, than even we are. And so, if they come to us and say, hey, it's time to sell because, this challenge is on the horizon, or so-and-so is about to enter the market, that we listen to their guidance. I think probably the best example from our history is a situation where, a company is in the medical device space. Company was growing very well, was gathering attention from various different people, and Johnson & Johnson came and knocked on the door and said, we'd like to buy you, and if we don't buy you, we're going to enter the market. And the management team, said, what do we do? And our partners respond to the management team, hey, do you think we should talk to them? Management team says, well, yeah, it's Johnson & Johnson, and, why don't we just put a number out there and see if Johnson & Johnson wants to take it? And, if they'll buy us for, that number, then, yeah, it's a lot easier to do that than slog away against Johnson & Johnson. And that's how it happened. The management team said, hey, we do want to talk to them. We put a number out there, and Johnson & Johnson actually hit it. And, it avoided a lot of headache for everyone, and it was a good transaction for all. We've gone through, KLH exited 4 companies last year. One of those was a strategic that approached our portfolio company and approached us and said, look, we're familiar with the business. We'd like to buy you. We negotiated a deal quietly. It was good for all parties. It was executed. We ran exit processes on 2 other ones, mainly because management came to us and said, look, it's been 5 years. We're going to have to refinance the balance sheet anyways because a lot of the debt was maturing. My ownership position is X. I'd like to get liquidity for half of X and then keep, the other half in the business. So it's time to do this. The business has grown. I can make a little money. We executed those. And then the other exit was a situation where we were actually only a lender in that situation. Management had already purchased our equity from us because, they really believed in the growth of the business and wanted to buy our equity back. We negotiated that, and then they got approached directly by a private equity firm that said, hey, we want to pay X, and, that happened. So I think all those examples point to, these things happen, and you don't have to force them and say, at X date we're selling. The time to exit naturally occurs, and everyone kind of recognizes it. So we don't, while we have, drag-along rights in our documents to force people to sell, we've never executed them, ever.
So in other words, that you do have that conversation with management up front about when the exit may occur within a certain time frame, right?
You know, to more specifically answer that question, we the majority of the financing that is utilized in our transactions will have a maturity date that's typically 5 or 6 years from the date of the original transaction. And so, you know, that in and of itself creates a point in time where a strategic, you know, capital budgeting decision is going to have to be made about, you know, do we refinance the business and stay in, or do we all look for the door, or do some of us look for the door? And so there's kind of a self-perpetuating time frame that kind of happens because of the debt. And so the conversation itself happens, and everyone knows that at that point, you know, kind of 4 years out, there's going to be a conversation if there hasn't been one. But I think the key distinction is that what we decide to do at that, you know, fourth year is not going to be dictated by KLH. It's going to be, you know, driven by management's preferences at that time.
That's a great point. Thanks. I just wanted to make sure I was in the range when I was saying 3 to 7. And I do like the style that you bring to the table as well, too. It's management driven.
Right.
Great. Paul, does that answer your question?
Oh, it certainly does. Thank you.
Okay, I'm going to turn your microphone off. We have one more question, and that is, when someone engages with KLH, how long does it take for you to assess the company, and what's the probability that it will be a successful relationship versus how many do you accept, how many do you reject?
Yeah, so if you kind of think about our funnel, I mean, we see a tremendous amount of opportunities every year. You know, a good number of them aren't a fit because they're in an industry we won't invest in, or they're too small or too big, or they're, you know, too far away for their size to warrant the attention or something like that. And so, you know, I would say it's kind of a factor of 10. From, you know, 10% of what we see is actually kind of a fit for us. Of that, you know, 10%, once we dig in, is a good fit. And then of that 10% that is a good fit, you know, we hope to close, you know, 10% of those things we're interested in. That ends up being, you know, our target is kind of 3 platform investments a year. So, you know, we need to, you know, if all else is holding true, we need to see about 3,000 opportunities, and that's every shape and size of opportunity, obviously, at that number in order to kind of hit our target. You know, in terms of once we get to, you know, as Kyle talked about on page 17 of the presentation, you know, once you hit that letter of intent stage, once you hit letter of intent, you know, I think the probability of closing is far greater than 50%. You know, I don't think it's 90%, maybe 75 is reasonable, but, you know, by the time we sign a letter of intent, you know, our firm is of the size, you know, there's 8 individuals that work at the firm. 4 of those have votes in the investment committee. You know, we're all going to have seen that LOI. We're all going to know what the business is. We're all going to know what we're signing up to invest in. And unless there is something that fundamentally changes between our understanding at the time of letter of intent and when we go into diligence and get through our diligence, you know, that deal is going to close. And so, you know, typically what happens, deals fall apart because, you know, the numbers aren't what someone said they were, or there's some massive, you know, lawsuit or customer problem or something like that, you know, wasn't articulated to us pre-LOI, and that's what blows up a deal. But if everything is as advertised, you know, once you sign an LOI, it's closing. And the typical time frame for closing, we say that it's kind of 10 weeks from signing of an LOI to closing. I think it really is more like 12 because inevitably there's a week or two of someone going on vacation or holidays or stuff like that. But it's basically a 3-month process from LOI to actually, you know, being fully signed and funded. And part of that is because of the time it takes to raise the outside financing. There's about 6 weeks in there, 6 to 8 weeks that is raising the financing and getting that in place. And we run that concurrent with our diligence and concurrent with, the documentation of our acquisition. So.
Okay, great.
We've done it quicker before, but it's everyone develops a lot of gray hair.
Well, gentlemen, William, Kyle, thank you very much on behalf of Navocate. We very much appreciate your time. We know how valuable your time is. And for those of you who have joined us today to listen to this webcast, we thank you for your time as well. As I mentioned, this will be recorded. We'll be reaching out to you to ask you to complete a survey and also give you access to the video if you missed part of the presentation. We're sneaking up on an hour here, just a few minutes left. I don't see any more questions, so I think we have reached the end. Again, thank you all for participating, and check in on the Navocate website for additional webcasts that we're doing. We do them about once a month on the topic of sales, selling a company, buying a company, corporate acquisitions, and private equity, as you've listened to today. Thank you again. Have a great day, and we'll talk to you soon.